What's up everyone, it's Caddy with Money Vesting. So in this video, I will be sharing 5 things which I believe are going to happen in 2023. So it's going to be a little bit of a prediction style video where I will be going over my 5 approximations of what I believe is going to take place in 2023. And I've also got, summarized notes from a couple interviews that I was able to watch for Professor Demodron and Tom Lee as well. So we will be talking about those because it's quite interesting how they're very, very similar to what I've also talked about on the channel before, literally months ago. And when it comes to Tom Lee, the question was simple, right? It was asked, what would it take for Tom Lee to be less bullish? And it was quite interesting what he ended up saying. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, the first week of the month is the best time to join and get access to all the private videos and the trade alerts and swing trading ideas, options alerts, all that stuff. The link's going to be down below if you're interested in joining us. So first things first, talking about Professor Demodron, by the way, he's accepted our invitation to be on the channel for an interview. So hopefully we can get him on board for 15 to 20 minutes to kind of pick his brain and really get his perspective on the markets, valuations, and the economy. He is a busy guy, so we've been going back and forth since November. There's obviously been semester schedules by NYU, so I totally get it, but I promise we'll make it happen eventually. He's also traveling right now, so we'll definitely get him on board. But nonetheless, he was on CNBC 12 hours ago, talked a little bit about there are 2 macro issues that are driving the markets right now. Number 1, what will happen to inflation this year, next year? And number 2, what will the economy actually do? So those are the 2 macro events, macro issues that are driving the market. And he says that it's amazing how the story of the market keeps on changing every day, every week, and every month. In January, it was all good news. Inflation is benign. It is rolling over. It's coming down. Markets rally and push higher. February, the mood shifted and we saw the yields also push higher. And on these prints, the hotter than expected prints in February for January inflation, we obviously saw the markets under pressure and come right back down. And the first few days of March, once again, the mood was great. Stocks pushing higher. We rallied. But yesterday we were back down on Jerome Powell's testimony in front of U.S. Senate. Now, Professor Demodron says that this is what we will see for the rest of the year in 2023. This exact consolidation, volatility, and back and forth is what we will or we could see in 2023. And he said that this is why market pundits need to take a step back from the tape because we really don't know where the markets will go. But instead, we need to see until we see what happens with inflation and economy that will drive the markets moving forward. And it's not about the Fed and what does it do and what it doesn't do, but instead it is more about inflation and economy. The Fed is more of a side story. Now, in my previous videos from last year, I've talked about how inflation is a leading indicator. It is literally the only leading indicator that we need to be paying attention to because that is what's actually driving Fed's narrative. That's what's actually driving what the Federal Reserve is going to do. And in return, that's what's actually driving the bond market and the stock market and what we're seeing on a day-to-day, week-over-week, month-over-month basis. And he also mentioned the moment you actually forget that inflation is a problem, the moment you actually focus too much on the fact that inflation is maybe coming down and the Federal Reserve is going to pause and pivot, you see a pretty strong rally. But the moment you realize that in reality, inflation is still sticky, it's still higher, and the Federal Reserve is going to continue to hike rates, the markets are under pressure and they start to come right back down. He also says that his historical experiences with inflation are that it is incredibly stubborn. So does that remind you of somebody? I even mentioned an analogy of pretty much losing weight. Remember how inflation was something very similar to, let's say, a person losing weight? You can lose and shred a few pounds in the beginning, but getting down to your target weight and getting down to the last percentage of your body fat if you are trimming is incredibly, incredibly challenging. And Professor Demodron pretty much mentioned this, and he said that you can bring it down a little bit, but it doesn't go away easily. So when people say that inflation would come down to 2% by the middle of this year, that goes against everything that we know about the history of inflation. And inflation will be a lot more stubborn. And the Fed also sees the stubbornness of inflation and that the 2% inflation will not be so easily achievable without breaking something in the process. So he's very clear about his analysis and his thesis. He pretty much says that, look, inflation is going to be stubborn. It is going to be sticky. It is going to be more and more challenging to bring down. And the Federal Reserve sees that, and they're not going to be able to bring it down without breaking something. So quite an interesting analysis, kind of like very similar thoughts, right? That's why I want to have him on the channel. Like I really want to have a conversation with him to kind of get his thoughts and his perspective on the valuation, the price to earnings multiple, the earnings yield, and the bond market, the credit spreads, the inversion of the yield curve, recession narrative. Like there's a lot of things that we can discuss, and I'm super excited for that. So hopefully we can figure out a time and a day and time here. But moving over to Tom Lee here, Tom Lee says there is a misconception that the stock market has to go down while the Fed is hiking. So a little bit of a different perspective. Obviously, Tom Lee is kind of synonymous with bullish, but he did mention that, in the last about 14 hiking cycles since 1970s, when the Fed was raising rates in a 24-month period, 11 of those 14 cycles, the market actually ended up pushing higher, hitting new all-time highs while the Federal Reserve was hiking. But there was a question, a very important question asked to Tom Lee: what would make you less bullish? What would it take to make Tom Lee less bullish? And this is what he said. He said, if we are hurtling towards a recession, I think that would be tough for stocks to actually rise. That's what he said. If we were hurtling over to a recession. And he said that, there were predictions about a recession last year, but the economic indicators were so strong, they continue to come in super strong, and we're still waiting for the recession metrics to show up. So if there is no recession, stocks can rise. If there is a recession, if you hurtle into a recession, if you're moving towards a recession, it will become more difficult for stocks to actually rise. So it's quite interesting where recession, which is the most probable outcome right now in the US, at least according to me. And, I don't know about you guys, but comment down below. What percentage would you put right now on the US economy entering a recession sometime, let's say in 2023 or 2024. Yes, it takes time. Yes, there's lags. It doesn't always happen right away. I mean, just because the Federal Reserve hiked rates in the last 1 year doesn't mean the US economy will enter straight into a recession a month after they started hiking rates. No, the effects of these higher interest rates will take time to play out. We're just getting up to over 4.5%. We're just possibly getting up to over 5%. And we already know that there is a 50 basis point hike potentially coming in March 22nd. The probability of that is also increased to over 55, closer to 60%. And the probability for us to see another 100 basis point hike, so 50, 25, 25, is also going higher. So higher terminal rate, and we're going to stay there for longer. That potentially could, in my opinion, will impact the markets. And of course, the economy could potentially break, and leading to, of course, recession and higher unemployment. So these right here are going to be some of my predictions for 2023. These are some things that I'm actually calling for. In my opinion, I think these are things that have a very high probability of happening. And look, let me be very clear. If none of these things happen, right, let's say that I'm completely wrong and this video does not age well and this is completely wrong and none of this happens, then the market's going to be in a very, very good position. They're actually going to be higher. So I want myself to be wrong because I don't want the markets to be lower, of course. But this is the reality, and this is what I believe to be the reality of 2023 and 2024 going over the next 24 months. And like I said, look, I'm not trying to paint a picture here or bearish or bullish, but I want you guys to be prepared. If you are prepared for this, then even if this doesn't happen, you will be in a very good position, right? Markets will be higher, and of course, we will be collectively in a much better position because stock market's higher because these things did not happen. But if you prepare for this and it did happen, well, you'll be fortunate and you'll be thankful that you prepared for it. So that's exactly the mindset that I'm going in with this. Just because I believe in this doesn't mean that I'm going to be selling my stocks, everything today, and kind of liquidate my positions and kind of go all cash. No, I'm still invested for the long term. I'm still bullish for the long term. I still believe that over the long term, 5, 10, 15, 20 years, there's a lot of potential, and I want to be invested in the markets for the long term. Just because my short term, intermediate term focus is that things are going to be a little bit more turbulent, things are going to be a little bit more challenging, doesn't mean that I need to sell all my stocks. So like I said, I want to be wrong over the next few months here, but if I'm not, I'm prepared. That's the mentality that I'm going in with. First things first, we are going to be talking about inflation turns into stagflation, in my opinion, and stays above 4% for the next year. So by 2020, by the end of 2023, it pretty much turns into stagflation and we start going sideways. It is going to be more and more stubborn to bring down, in my opinion, and Professor Demogren seems to agree. So in my opinion, it will be sticky and it will turn into stagflation and stays above 4%. Doesn't come down fully down to the Fed's target, but comes down, down enough, but still starts to trade sideways and pretty elevated from the Fed's target. In other words, twice as much as what the Fed's target is and turns into stagflation. Let me know your thoughts down in the comment section below. What do you think about these estimates? Next up on the list is going to be unemployment. Unemployment, in my opinion, rises to above 4%. So as interest rates continue to get pushed higher, eventually we start to see unemployment kind of have some cracks and starts to kind of creep up a little bit as either more people get unemployed or more people start to participate in the labor market, thereby increasing that participating labor force, and rising unemployment is a possibility and gets up to over 4% by the end of this year, by end of 2023. Third estimate is going to be that earnings recession happens after first quarter 23. So first quarter 23, meaning the quarter that we're currently in. We're going to close this quarter out in March. We already got the fourth quarter earnings to have been declined by close to 5%. And earnings recession, in my opinion, will take place. If they'll technically be an earnings recession if the earnings decline in the first quarter 23, which in my opinion will happen considering what estimates we're seeing from companies, the guidances that we're seeing, and the analyst estimates as well. So in my opinion, earnings recession takes place after the first quarter earnings are released for 2023. And again, let me know your comments down below. I'm interested to see what everybody comments in the comment section down below for this. Next up, economic growth contracts in the first half of 23. So economic growth meaning GDP. GDP starts to pull back, and we actually see a contraction in the first half of 2023 with respect to how interest rates are going higher. And they're going to stay higher for longer. So because of that, I do believe that economic growth is also going to really struggle with respect to consumer spending. Now, this could also be turned into second half of 23. And the reason for that is consumers are still pretty flooded with the cash and savings. And we're not going to see the real pain for consumer spending until the second half of this year, because there's an estimation that consumers are going to pretty much run out of their savings by the middle of this year. So it can be both first half or second half of 23 or the entire year 2023. But I do think that economic growth is going to contract in 2023. So you can pretty much put down 2023, except for like me timing it with first half, second half. I believe economic growth and GDP is going to contract this year in 2023. Next up, we've got the Fed funds rate, interest rates sitting above 5% by the end of this year. In other words, we are already at 4.5%, and another 50 basis points is going to get us to over 5%. And the Federal Reserve and Jerome Powell is going to probably keep us there for a little longer. And in my opinion, we're going to stay above 5% by the end of the year, considering that inflation is pretty stubborn, staying above 4%. And even though unemployment rises above 4%, that's not going to be a strong enough catalyst for the Fed to start cutting rates because of how strong the unemployment would still be, even if we are above 4%. Like 4% is a target, but I do expect unemployment to rise up to 4.1, 4.2, even as much as 4.5%. I think that's very reasonable. And it's still low enough for the Federal Reserve to not start cutting rates. So interest rates, in my opinion, to stay above 5% by the end of this year. And last but not least, we've got a possible economic recession by the end of this year. So that's kind of like in line with economic growth contracting in the first half of 23. So possible economic recession by the end of this year. So these are some of the estimates that I have, for 2023. Let me know down in the comment section below. What do you think? But yeah, that's about it. That's my entire video. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe if you're new. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And I will be sharing some tips and tricks and ideas on how to kind of position yourself if you are kind of in line with what this analysis is. And I will be sharing my written analysis on the Market Updates channel later this week, kind of probably over the weekend, going over like an entire paragraphs of what I believe is the right way to position yourself in 2023, considering what we're seeing from the markets and of course the economy as well. So as always, happy investing, and I'll see you all in the next video.